Today, we're going to deconstruct a really fascinating framework called the reflexivity model. It's designed to be a kind of fragility monitor for the financial markets, and it makes us ask a pretty uncomfortable question.
I mean, you look around, you see these massive valuations, especially for the big tech names, right? The Magnificent Seven. But is that strength built on rock-solid fundamentals? Or is something else going on? Could it be that the market is caught in this powerful feedback loop where its own mechanics are just creating the illusion of strength? That's the core mystery we're going to dig into today. Okay, before we dive any deeper, we have to be crystal clear about something the source material really hammers home. This model is a tool for analysis. It's a way to monitor the system sensitivity. Think of it more like a weather station for financial storms, not a crystal ball that tells you when the storm will hit. It is not, and I repeat, not investment advice.
So where does this investigation even begin? Well, it all starts with the model's central hypothesis. This is the engine that drives the whole thing. This powerful and maybe fragile idea of a reinvestment feedback loop. Now, what's so interesting here is the analogy they use. We all kind of know how banking works, right? Banks use leverage, debt, against their reserves to expand the money supply. Well, the hypothesis here is that the stock market might have its own version of that. But instead of debt, companies use their own free cash flow to reinvest, and in doing so, they might just be multiplying their own valuation.
In this slide, wow, it just lays out exactly how that loop can work. So a company spends on capex, which can boost its own revenue or maybe the revenue of its suppliers. Better performance means more cash for stock buybacks, which, reduces the number of shares out there. This, in turn, boosts the company's weight in the big indexes, which then forces passive funds to buy more of its stock, which, you guessed it, supports its valuation. It's this incredible self-feeding cycle that can keep going and going, but it also makes the whole system much more sensitive.
Okay, so to figure out if this loop is spinning, and maybe spinning a little too fast, the model tracks three key internal signals. Think of these as the dials on our dashboard. We need to decode them to really get what's happening, so let's break them down one by one.
First up, we've got valuation elasticity, the Greek letter epsilon. The easiest way to think about this is like a rubber band. When epsilon is low, near 1, the company's valuation, the rubber band, is staying pretty close to its actual cash flow. But when epsilon gets really high, whoa, that means the valuation is stretching way, way out, far away from the fundamentals that are supposed to be anchoring it. It's a huge sign of decoupling.
Next, we're looking at reinvestment intensity, or I. This one is super straightforward, but really powerful. It asks a simple question. Is a company living within its means? If this ratio creeps above 1, it literally means the company is spending more money on things like new factories and stock buybacks that it's actually bringing in from its operations. That's an aggressive move, and it might mean they need outside funding to keep that feedback loop spinning.
And our final internal signal is dilution pressure, or phi. This one's fascinating. You can think of it as a tug of war. When phi is negative, buybacks are winning the war. They're concentrating ownership and basically acting like an anti-gravity force for the stock price. But when phi turns positive, it means new shares from things like employee stock options are flooding the market and overwhelming the buybacks. This acts like valuation gravity, creating a natural downward pull on the price. But here's the thing. All these internal financial games don't just happen in a vacuum. The model argues that for real, systemic fragility to show up, this self-reinforcing financial world has to slam into the hard, cold reality of the physical world.
And the model splits this perfectly into two clusters. You've got cluster A, that's everything we've been talking about, the internal financial loop, and then you have cluster B, that's the outside world knocking. These are the real-world frictions, stuff like high energy costs, messed up supply chains, and tightening credit that you just can't ignore. The real danger zone is when a supercharged cluster A runs headfirst into a stubborn cluster B.
But wait, there's more. Even that collision isn't enough. The model needs one last piece of the puzzle, a final confirmation. For the risk to be truly system-wide, the bond market detectives, often seen as the sober grown-ups in the room, have to agree with the story the stock market is telling.
And here's how they send their signal. The model keeps a close eye on credit spreads. That's the extra interest investors demand to hold riskier corporate debt. When everything's green, spreads are tight, everyone's happy. Amber means, investors are getting a little nervous, spreads are widening out. And red? Okay, that's a full-on alarm. It's a clear signal of serious stress, and it confirms the fragility we're seeing in stocks is becoming a much bigger problem.
All right, let's put it all together. We've gathered all our clues, we have the internal feedback loop, we have the external pressures,
And now we have the confirmation from the bond market. So what happens when all of these signals start flashing at the same time? Well, that's when we enter what the model calls an elevated fragility regime. And this isn't just some vague feeling, okay? The model has a very specific checklist. Both valuation elasticity and reinvestment intensity have to be screaming hot in their top 80th percentile historically. Dilution pressure needs to be pushing down for at least 2 quarters straight, and external pressure, like high oil prices, has to be sticking around. And crucially, credit spreads need to be widening. Once you check all those boxes, the system is officially on high alert.
Let's just circle back to this point because it is so important. This model is not a psychic. It's more like a seismograph. It doesn't tell you the exact time and date an earthquake is going to happen. What it does is identify periods when the tectonic plates of the market are under incredible stress, which makes a big seismic event much more likely.
So what's the monitor saying now? Well, according to the source document, which is looking at data from late 2025, it seems the conditions for fragility are definitely elevated as we look ahead to 2026. But remember, this is a live reading. The situation can and will change, depending on what happens with earnings, credit, and everything else from here on out.
And that leaves us with the final and maybe the most important question of all. This model gives us a framework, a way to see when risk is building up under the surface. It monitors the sensitivity, not a specific date on the calendar. So the real question is, when a system like this starts flashing all its warning signs, who out there is actually listening? And what will it take for that listening to finally turn into action?